Welcome to Dr. David Eifrig's Health and Wealth Bulletin. This is Weekly Update. Earlier this week, President Trump announced that he was pulling the U.S. out of the Iranian nuclear deal. Now, we have a lot of questions about what that means for us and for the markets. So with me today is Bill Shaw, the editor of Commodity Supercycles. Bill, what can you tell us about what's going on and what we can expect to see?
Sure, thanks, Amanda. We heard a lot of headlines, a lot of noise on Monday about this deal, although I think most of us expected it. Trump's been talking about this since he was on the campaign trail, about it being a horrible deal and a one-sided deal. It did cause oil prices to spike a little bit, but I don't believe it's going to have much of a long-term effect at all on pricing. Just to give you a couple numbers, right now, currently, Iran produces about 3% of the world's output, about 2.7 million barrels per day. Most analysts are suggesting that in the short term, these sanctions will take off about 200,000 barrels per day, ramping up to maybe 500,000 in 6 months and peaking out at 1 million barrels per day, which is only about 1% of global demand. So it's not a big amount. Further, I expect them to work out a deal. This has been devastating for Iran's economy. Their currency's fallen 50% since October. Their unemployment rate's almost 13%. I expect cooler heads to prevail and for them to get a deal done. But it's not the only thing affecting the oil markets. Venezuela, as you know, has undergone a complete economic collapse, and they're a big oil-rich nation. And they were producing 2.1 million barrels per day in 2017. And reports out of there last week is that that's down to 1.5. So that's 600,000 barrels per day that's already come offline. So I think that could have had an effect on oil prices as well, despite not hearing a lot of headlines about it. Either way, the world's still awash in oil. A couple years ago, worldwide reserves were about 325 million barrels, which is or 325 million barrels above 5-year average capacity or average stockpiles. Now that's down to about 30 million barrels. One of the big reasons is OPEC has cut production to try to mop up some of that extra surplus. In the wake of production falling off in Venezuela and Iran, Saudi Arabia can jump back on. They've got 1.7 million barrels per day that they're just sitting on that they could release back into production. Kuwait has another 300,000 barrels. So all in all, it's a small blip. I think speculators are the biggest reason oil prices are so high right now, and inflation.
I know oil prices just hit just past $70 a barrel. Do you think it's going to keep going up, or do you think we're going to hit a point and it's going to level off?
Yeah, I think it'll bounce around a little bit in the 70s. I have a hard time seeing it get above 75. Of course, if you would have asked me 6 months ago if it would have been at 70, I would have said no way. So it's hard to tell with all the the future speculators, but short term I'm not bearish, or I'm not very bullish on oil. I see maybe hitting 75 and before it goes back down. So
you're bearish on oil. What are you bullish on right now?
We still have a lot of exposure to oil in our portfolio. We kind of stick to what we call the best of class in each category. We have a couple exploration and production companies, a couple midstream pipeline companies, and an oil field gas services company. But we're not looking to add too much to those, but we're going to stay long with them. One thing that's been interesting to us is liquefied natural gas. That's been an exciting space to look at. Demand's creeping up around the world, especially in China, as they try to get away from coal. The U.S. is building export facilities for liquid natural gas. We saw just one open this winter, Dominion Power here in Cove Point, Virginia. So that's kind of exciting. And just commodities in general, they're historically cheaper than they've ever been. The sector as a whole, even though short-term bearish on oil, long-term bullish on all commodities. And if you're concerned about the volatility you've been seeing in the markets lately, a good way, if you don't have any exposure to gold, a good option would be to buy a precious metal streaming and royal company. royalty company. These companies pay money up front to miners to help finance their mining, and then they get a stream or a royalty based on production. They're much more stable and less risky than buying a mining company. One in particular I like a lot right now is Sandstorm Gold. So if you don't have any gold in your portfolio, that's one to look at.
Great. Well, if you are interested in commodity supercycles, the oil companies that Bill mentioned, and some other great ways to hedge your portfolio, we're going to have a link in the description below so you can get started with a trial to that publication. Thanks again for joining me, Bill.
Thanks, Amanda.
And in the meantime, don't forget to like, share, and subscribe, and we'll see you next week.